Well, that's a perfect segue to the Fed's policies. I mean, Edward, how do you feel about the Fed's policies here? There have been some concerns that the Fed's policies are actually holding back the economy. What's your sense?
My sense is that we're not operating in a free market society as it relates to treasuries. I mean, we have a Federal Reserve with a $3 trillion balance sheet, adding $85 billion a month, so it's going to be close to $4 trillion by the end of this year. And they're truly an artificial buyer as it relates to MBSs as well as treasuries. And you know, it's definitely painful for the savers out there because they're not getting an accurate rate on their return on their investment. And I think really that the canary in the coal mine is going to be what's going to happen to yields once we get a curtailment or termination of this QE program.
Well, but how do you think? Oh, go ahead, Chris.
I'd say, Edward, you know, your point about low interest rates, I agree wholeheartedly. Don't you think after several years, if not quarters, that that's actually pushing people finally into the market after such a big move? You know, we saw strong January inflows, and we heard Jason talking about his business where he's seeing a lot of applications and things like that.
Yeah, we're definitely seeing flows. We're also seeing record low yields on the junk bond market. The one thing that we also take a look at is the sentiment readings. And one thing we didn't talk about is the NYSE margin debt, which right now, the last reading we got was for December of last year, and it peaked over $320 billion. And I hate to say it, but the last time we were at levels this high was the credit crisis of 2007. So there is definitely a lot of retail borrowing occurring to participate in this marketplace, and that on the margin does worry me.
But let's step aside a minute from the wealth effect. I understand the whole idea that Bernanke is trying to get the market to go up and then get consumers to spend and so on and so forth. But do you think that this ZIRP policy is hurting banks, and therefore, although rates are at zero and that's an incentive for borrowers to borrow, is it really an incentive for lenders to lend, right? We know that credit is the oxygen for an economy. Edward, then Chris.
I think that, yeah, on the margin, if people know that interest rates are going to stay down this low, there is not an incentive to go out and borrow necessarily today if they know that they have 6 months to do so. That being said, I still think it's a penalty for savers. And the biggest risk, I think, is that if we got a continued backing up in the yields, I mean, the convexity on these bond portfolios is going to be enormous, meaning that, you know, the average 30-year bond last month was down about 6% in an actual return. So you've wiped out pretty much all of your interest payments for the whole year, if not more, in one single month. And a lot of people, I think, have been talking about this, and it's going to be something that the Fed needs to keep in mind as it tries to navigate its way through this program.
Chris, go ahead. You were going to make a point.
Well, I was going to say that, you know, we're seeing mortgage rates tick up a little bit, and I actually think that's a good thing. You know, once people start to see mortgages rates ticking up, you know, the people who are sitting on the fence, those indecisive buyers that Edward was kind of alluding to, they actually might get off the fence and into the marketplace, and that could be a good thing, particularly for the housing economy.